Hey everybody, Mike here from Practical Income Investing. So Micron just gave investors one of the clearest signals yet that the AI memory trade is real. Uh, but here's the question: did the report create a new opportunity, or did it confirm that the trade may already be getting expensive? That's what I'm going to talk to you about this video because it's not just about Micron having a good quarter. This is about whether the old memory cycle is changing. Historically, um, memory has been one of the most cyclical parts of the semiconductor space for a long time. Demand gets hot, uh, companies add supply, supply catches up, price falls, margins get hit, and the stock resets. This is a cyclical thing, happens all the time, constantly. But AI may be changing that now. With high bandwidth memory, DRAM, the memory bandwidth, storage, all of these things becoming more important because AI systems need to be fed massive amounts of data, and that data has to have some kind of memory to go to it. So today I'm going to go. I'm going to go into a deep dive with Micron and report what actually they reported. Let's see what they actually reported, what it actually means, why this cycle may be a lot different than it used to be. I'll give you the bull case. I'll give you the risks, um, and why their great earnings don't automatically mean it's a great entry. It could be, but we got to check it out. So, as always, this is not financial advice. I am not a financial advisor. This is for educational purposes only. But hope you can take my research and do something good with it. So, there we go. Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. This is the main question of the video. Micron just reinforced the AI memory thesis in a big way. But I want to be careful with the way I think about this. A stock can report excellent numbers, confirm major theme, and still be difficult to buy after the move. That is the difference between understanding the business and chasing the stock. This thesis may be getting stronger, but the entry still matters. So that's the real practical income investing lesson here. We want to understand the opportunity. We want to, but we don't want to repeat the valuation risk, position size, and other risks that might occur in this thesis. This is not just another generic chip rally. The old way people thought about memory was pretty simple. PC demand gets strong, smartphone demand gets strong, server demand gets strong, and the memory stock runs. The demand slows, inventories build, price weakens, and the stock gets hit. That is the old memory trade. But the memory AI trade is different, or at least the market is starting to ask whether it is different. AI servers use a lot more memory. High bandwidth memory, DRAM, are becoming like performance bottlenecks, really. Customers are are locking in supply for years. The memory supply suppliers may have like pricing power if the demand stays strong and the supply stays tight. So the real question is not, did Micron go up? The question is memory just a commodity cycle, or is it becoming a strategic AI infrastructure? Now let's start with the actual numbers. Micron reported record fiscal third quarter results. Revenue came in around 41.46 billion, and non-GAAP earnings per share came in at $25.11. They also reported 22 billion in customer commitments tied to memory supply agreements, as I talked to you before. And management is talking about tight AI memory supply extending into the future. So that's the important part of this, not just because it just beat normal the normal thesis, what the analysts were thinking, but this wasn't just like a normal good quarter. This is Micron saying to customers or trying to secure supply. That matters because if customers are willing to make a multi-year commitment, that suggests memory will be shifting from short-term cycle commodity into something closer to strategic infrastructure. Now, one of the things that eliminates risk is that structure, but does it change the conversation? And this report didn't just beat expectations, it reinforced the AI memory thesis. Well, before we talk about why this cycle might be different, we have to understand the old memory cycle and how it actually looked. When investors say memory is cyclical, this is what they mean. Historically, memory's been about a cyclical business. That means it moves through booms and busts. When demand is strong, for PC phone servers, cloud orders, memory prices improve, and the companies start making a lot of money. Then the industry does what it always does. It adds capacity, more factories, more production, more supply. And that works great until supply catches up with demand, and worse, supply overshoots demand. Once that happens, memory prices fall, margins get hit, earnings fall, the stock usually reset. And when investors say memory is cyclical, this is what they mean. Demand rises, supply expands, prices fall, then supply catches up, then the cycle starts all over again. So, why might this cycle be different? The old memory world has heavily driven by consumer devices. It was PCs, it was phones, gaming systems, traditional servers. There are important markets. I mean, these are important markets, but they can move in cycles. A product cycle gets hot, companies build inventory, the demand cools off, right? So, but what about AI data centers? Are they different? These are massive infrastructure projects. They're not built like one product cycle here. They're built for training, their inference, their data movement, storage, long-term commute demand or compute demand. I mean, this is where memory changes. AI data centers need more memory per system. High bandwidth memory, HBM and DRAM, can become bottlenecks. Supply takes time to build, and customers may be willing to lock in supply because they can't afford to be short of memory. If they're building an AI infrastructure, they got to have this memory. So I'm not saying that the cycle's dead, but that would be too aggressive, I think. But I think the cycle may be changing. Memory may be moving from a commodity input into strategic infrastructure here. This is the key idea. The market talks about GPUs because GPUs are the headline. But AI does not run on GPUs alone, and GPUs have to be fed with data. That means the system needs HBM, DRAM, NAND, storage, networking, power, cooling, all working together. HBM is especially important because it sits close to the AI processor, and that helps move data fast enough for the system to perform. AI, the memory cannot keep up. The GPU can become less efficient. That's why memory is no longer just a background component. It's the AI era. Memory can become a strategic bottleneck. If the memory is the bottleneck, then the memory suppliers may have more pricing power than they had in past cycles. Okay, so HBM stands for high bandwidth memory. The simple way to think about it is this: AI chips need data fast. The faster and more efficiently memory can feed data to the processor, the better the system can perform. That's why HBM matters so much. It's close to the AI accelerator. It helps move data faster. It supports larger models. It supports longer context windows. It supports training and inference. And because HBM is complex to manufacture, supplies can't instantly appear just because demand is high. That's why investors care. If HBM is constrained and demand keeps rising, then memory suppliers can potentially gain pricing power, which they have. And that's the bottleneck behind the bottleneck. The GPU gets the headlines, but the memory help decides how fast AI can really run. All right, now let's talk about the bull case. The bull case isn't just Micron went up. The bull case is AI demand is real and it's accelerating. HBM supply is tight. Customers are making big commitments. Pricing power may last longer than a normal memory cycle. Margins may remain larger and stronger because supply is constrained, and memory may become more strategic part of AI infrastructure. That's the whole why this is interesting part. If this is just another memory boom, the fear would be obvious, right? Demand is hot, supply comes in, pricing rolls over, cycle ends. But if AI data centers demand stays strong for years, which they're projecting, and if HBM and advanced DRAM remains constrained, then this cycle is going to last longer than investors anticipated. That's why the market is getting excited, right? It's not just the current earnings, it's the possibility that Micron has better demand visibility and stronger pricing power than it had in past cycles. That's the bull case. All right, so we can't just talk about the bull case. Here's the risk case and why it still matters. Memory is still memory. Supply can eventually catch up. CapEx is rising across the industry. Pricing power can fade if tightness eases. After a huge stock move, some of the future returns may already be pulled forward. The last point is important. If the thesis is right and the stock can become risky if expectations are too high, so that's where investors can get hurt. They see a great report, they see the stock run, they assume the risk is gone, but sometimes the risk just changed. The business risk may be lower because the numbers are better, but the risk may still be higher because the stock already moved. So the risk case is not that Micron is suddenly a bad company. The risk case is that the market may have priced in too much of the good news too quickly. The cycle may be changing, but it didn't disappear. This is one of the hardest parts of investing. Sometimes the report proves the thesis, also makes the stock harder to buy. Before earnings, there's more uncertainty. After earnings, maybe the revenue beat, guidance improved, and customer commitments confirm the demand story. That lowers some of the business risk, but not all of the risk. What if the price already gapped up higher? Now the facts are better, but the price is higher too. So the business risk may be going down at the same time entry risk is going up. So that is why I don't want to just confuse a confirmed thesis with an automatic buy. Sometimes the right answer is to wait, stage in slowly, or use a basket exposure, like DRAM or something like that, instead of chasing like a full position or anything like that after the move. This is the practical income investing lesson. Great earnings do not automatically mean great entry. A report can confirm the thesis, the stock can reprice, risk reward can get tighter, and discipline still matters. It doesn't mean that the stock cannot keep going higher. It absolutely can. I think it is. I think it will actually. But as investors, we have to separate two questions. Question one is the business getting better? Yes. Question two, is the stock still giving me a good setup? I'm not so sure. Those are not always the same answer. Sometimes the stronger business creates more expensive stock. Sometimes the better facts create harder buy point. And that's why we don't confuse confirmation with free pass. The stronger business can still create a more dangerous entry. So, how I would think about exposure. First, I would not go all in. Position size still matters. Second, I would consider a basket exposure. Uh, the DRAM ETF or a memory basket can reduce a single company stock risk compared with trying to pick one of the perfect winners. So I would still think about DCA and staged buying too. That means letting the trade work instead of chasing a full position after a vertical move. I would keep focusing on the fundamentals. Remember margins, pricing, supply, customer commitments. How about capex? What are the big boys spending? And whether the AI demand remains strong enough to absorb that capacity. That's the framework. The goal is not to nail the exact top or bottom. It never is. The goal is to build exposure intelligently. If you already have some memory exposure, maybe you don't need to panic chase. If you don't have any exposure, you can, you don't have to force a full position all at once. I can respect the thesis, but you still have to respect the entry. All right, here's what I would watch next. First, HBM pricing and sold out status. If HBM stays tight, that supports the bull case. AI data centers demand trends. If cloud and AI customers keep building, memory demand may stay stronger for longer. Third, customer commitments and new deals, right? So the more customers are willing to lock up supply, the more this looks like a structural shift instead of a short term spike. So, fourth, gross margins and pricing power. That's where we can see tight supply that is really following through with the business. Fifth, we want to see capex and future supply additions. This matters because too much of the supply can restart the old cycle. The sixth, whether PC and phone memory also stays firm. If the AI story is strong, but the rest of the memory weakens, that one is a type of a cycle that we've been seeing. So the AI is strong and broader memory is firm too. That's the bit. That's going to be a very different type of setup. So next time, the next phase rather is about visibility. It's about pricing and the supply discipline. All right, here's the takeaway: the AI memory trade is real. Micron reports reinforce that. The cycle may be different because AI is creating a new type of demand for memory, but the risks still exist. Memory has historically been cyclical for a reason. Supply can always catch up, pricing can change, margins can compress, and the stock can move ahead of its fundamentals. So I don't want to confuse a confirmed thesis with a good entry. I do want to understand the cycle, respect the risk, and invest with discipline. That might mean owning Micron. That might mean using DRAM or basket exposure. That might mean staging in over time, dollar cost averaging, or it might mean just waiting for a better setup. But the key is this: don't chase the excitement. Understand the memory cycle, understand why AI may be changing it, and build the exposure the right way, not the fast way. So, this is my take on Micron and the AI memory trade. I do think the thesis is real. I do think the cycle is going to be different, but I also think entry, valuation, and position size still matters. Let me know in the comments. Did Micron prove the AI memory trade is real? And do you think it's too late or are we still early? If you found this helpful, hit the like, subscribe, and I'll see you in the next video. I appreciate your time.